Hello, this is Larry Pond. Today we're going to talk about when should I claim Social Security? It's one of the most common questions we get when it comes to tax and financial planning. So I hope this video is going to be helpful in helping you understand what considerations we need to think about when claiming Social Security. So let's get started. But first of all, a little bit about me. Well, first thing about me is um, it's my birthday. I just turned 62, so I do qualify to claim Social Security. So that's the first fact here. And so some people are asking me, are you going to take Social Security now? Well, I can tell you my answer is going to be no, and I'll explain to you why. But first, a little bit about me. My tax credentials are I'm a CPA, an EA, and a USTCP. And my financial planning credentials are I'm a PFS, a CFP, and an AEP. And I'm located here in Redwood Shores, California. I've been a tax professional since 1986. So, yes, this is year 40. And I love talking about taxes to tax professionals and financial planners. And I do this all over the country. And I also love teaching income tax to get more people into this profession. So here's what we're going to talk about today. So number one, what are Social Security benefits? Number two is how are these Social Security benefits calculated? And what is full retirement age? And what happens if I claim early? And what happens if I claim later? Now, we hear this from social media all the time. Will Social Security run out of money? And I'll talk about that and the myths associated with that. And the other thing we hear erroneously, and I hear this on the news or from politicians or most importantly, social media, is this new no tax on Social Security. Well, that's incorrect, and I'll explain that a little later here. And we're going to close with the Social Security Fairness Act and what that can mean to you. So let's get started here on what are Social Security benefits. Well, the Social Security Administration, the SSA, makes monthly payments to qualified individuals and their families. And this was signed into law almost 90 years ago by President Franklin Delano Roosevelt. And we had it since then. There's been a few revisions to the law, but it hasn't really changed a whole lot in many years. So, but the benefits haven't changed. So we have, first of all, retirement benefits. That's the bulk of what Social Security is all about, are the retirement benefits. And this was put into the law to prevent Americans from being destitute upon retirement. It wasn't ever meant to be your full retirement. It was just a baseline amount, a supplemental amount. It's one of the three legs of retirement that we talk about, right? Social Security is one of the legs, your personal savings, and then your retirement plans. So you got to put money in your retirement plans. You got to take some own responsibility too. All right, so retirement benefits are available to workers as early as age 62. It's based on the worker's personal earnings history, and the monthly amount is called the primary insurance amount, the PIA. The other benefits that Social Security provides are disability benefits. It's available to disabled workers at nearly any age. It's provided through the Disability Insurance Program, and it covers workers who meet very specific disability criteria. Then there are survivor benefits. It's paid to surviving spouses and dependents of deceased workers based on deceased workers' earning history. It includes benefits for aged, disabled widows, divorced widows, mothers with child in care, and dependent children. It also includes a one-time lump sum death benefit of $255 to certain survivors. And that $255 was set way back in 1954. Well, I guess back then it was enough money to pay for a funeral. Well, not today. And for that to change, Congress needs to update the numbers. It's got to be an act of Congress. It's not something the Social Security Administration can adjust due to inflation. Spouse benefits available to spouses based on their spouse's work history. And it's usually limited to 50% of the working spouse's full retirement age. benefit, FRA. There's also dependent benefits, provide to dependent or disabled children and or parents of deceased, retired, or disabled Social Security qualified workers. We're not going to spend any time on these benefits here. We're focusing on retirement benefits. Then there's also SSI, Supplemental Security Income. It's a separate federal welfare program that provides payments to individuals in financial difficulty due to age, blindness, or disability. SSI benefits are not subject to federal income tax, and they do not require the 40-quarter work requirement. It's a totally separate program. Now let's talk about how Social Security benefits are calculated. It's a complicated multi-step process based on lifetime earnings. But I think understanding the background will be helpful for you to understand how do I get my Social Security benefits? So let's go through the steps here. I think there's 5 steps. So step one, determine eligibility. You need 40 quarters or 10 years of covered employment to qualify for retirement benefits on your own account. And before even step one, you need a Social Security number. So if you have an I-10, um, that's not going to qualify. But if you later get a Social Security number, any credits you accumulated that you paid in under your I-10 could be transferred to your Social Security account, but only if you have a Social Security number. So step one, you need 10 years of covered employment. So that's pretty important to know, right? If you're short, then you know how much more you need to work to get to the eligibility. That's the most important thing. That eligibility also gives you access to Medicare Part A. Okay, step two is calculate the average indexed monthly earnings, the AMI. AMI. There's 2 steps to that. The first step is index your earnings. So what this means is Social Security can take your highest 35 years of earnings. So for the last 35 years, it's going to take your highest 35 years of earnings. Now, the earlier years are going to be indexed or adjusted to account for wage growth. And this applies to earnings you had before you turned age 60. So the years you earn before age 60 is going to get adjusted. So, for example, I started my first job. I think I was 16 years old. Yeah, I was 16 years old. Way back in 1980. In 1980, I made $5 an hour. Well, that $5 an hour is going to be indexed. And so for all the wages I've earned before age 60, that's going to get indexed. All the earnings after age 60 is going to be based on the actual amount. There's no indexing or adjustment going on. So whatever I earn after age 60 is going to be whatever those amounts are. So first, index your earnings. Next is average the indexed earnings. So add up your 35 highest indexed earnings years. So if you work more than 35 years, if there are any zeros, if you keep working, you kick out those zeros. Or if you keep working, you kick out all the lower earning years. And I think I'd never had a 0 year since 1980. I've always worked. So I think I've always have a number. But it's important to review your earnings history to make sure all your wages and earnings are counted. Because sometimes mistakes happen and might be left out. Okay, so you average index earnings. So you add up your 35 highest index earnings years, take that big total, divide by 420, which is 35 years times 12 months. So that's 420. So this gives you your AMI, your average index monthly earnings amount, AMI. Okay, then step three is to apply the benefit formula to calculate your primary insurance amount, the PIA. And that's your monthly benefit at your full retirement age. So the PIA equals, first step is 90% of the first $1,286. So that's 1157. That's the first point. The second point is 32% between 1,174 and 7,749 plus 15% of your AMI that's above $7,749. So these dollar amounts are called Ben points, and they get adjusted annually. And these numbers I use are for 2026. So this is update for 2026, and every year the Social Security Administration updates it because of inflation and those sorts of things. So that's step three. What is your PIA? Then step four is adjust for the age of when the benefits start. So actual benefit depends on when you start collecting. So if you collect before your full retirement age, which could be as early as age 62, the benefits are reduced. And we're going to go over that a little later here on how much it gets reduced. If you take it at full retirement age, that's 100%. And for 2026, that's age 67. And those are for people born after 1960. So we're at age 67 for full retirement age to get the 100% amount. Now, if you start after full retirement age, then the benefits increase with the delayed retirement credits. And now that it goes up 8% a year and it stops at age 70. So early, on time, or late. So that's step four. Then step five is we apply the cost of living adjustment, and it gets announced every year from the Social Security Administration based on the COLA or the index that they use. So benefits are automatically increased annually to keep pace with inflation. It's based on the condition of the Social Security trust funds. So there's some considerations you take there. So the more you pay into Social Security through your payroll taxes or self-employment taxes, the greater your benefit. And your principal insurance amount is used to determine benefits not just for you, but your dependents and your survivors. Now, if you die before reaching full retirement age, Social Security uses a special PIA rule to calculate the survivor benefits. So, do I want to go through this calculation? No. The Social Security Administration has online calculators, and I have some pictures of it here. So, ssa.gov/benefits/calculators. It takes you to this page. You can set up a My Social Security account, and through that account, you can download your Social Security report, and the Social Security Administration has done some calculations for you. Or you could go through the website here. The first one is My Social Security Retirement Calculator, and it kind of shows you what the benefits will be at age 62, your full retirement age, or age 70. The upper right hand corner one here, we have the retirement age calculator. So if I take it early, what's my benefit going to be? How much am I going to lose? And then there's the detailed calculator here, or the early or late retirement calculator. On the same webpage, you've got the earnings test calculator. So that is when you take Social Security before your full retirement age and you're still working, you got to pay back a portion of your Social Security. And this helps you calculate that instead of having to do it manually. Benefits for spouses calculator, the life expectancy calculator. You tell them your gender, you tell them your age, and boom, you get the life expectancy calculator. Is it 100% accurate? No, of course not, because it doesn't take into account your health situation, your lifestyle, your family history, and all those kind of things. There's an online calculator that is not connected to your account, but you play with the numbers on that. If you keep working, how much it's going to grow by. And there's the quick calculator. So there's these different calculators you can use. Now, the Social Security Administration used to mail these Social Security statements, and they stopped it a whole bunch of years ago, and they saved a lot of money by doing that. But I think once you hit 65 or later, they're going to mail you a copy of this, or you can request it through your Social Security account, or you can call Social Security, identify yourself, and they'll mail it to your address, your last known address, or something like that. Or you can make an appointment at the Social Security office and have them print this out at the office. So you get the statement. It's based on your numbers and all that. There's the retirement benefits, disability benefits, survivor benefits. Here's a nice chart on what the amount would be depending on what age you claim Social Security. So if you wait, it goes up. And then it talks about if you qualify for Medicare or not. Medicare Part A is premium tax free as long as you got your 40 quarters in. If you're short, it's good to know how much you're short by and how much you got to keep working. So the statement will calculate your estimated benefits. It's not the actual amount, but gives you a ballpark of what it's going to be, the retirement, disability, and all these things. Now, the next page of your earnings record, look at it very carefully. See if there's anything missing there. For example, for some reason, my wife was missing 1997. We don't know why. It showed a zero there. So we gave them a copy of the W-2 and then they updated the earnings record. Do this now because don't wait till you're going to apply for Social Security. If you find a mistake, we don't know how long it's going to take for them to fix it. So, instead of dealing with corrections and all those things, do it now, way before you're going to apply for Social Security to make sure your record is up to date. If you find mistakes, provide Social Security with the proof, either a copy of the tax return or your W-2 or whatever evidence to help them with the calculation. So the earnings record is going to be very, very important. So what is full retirement age? Well, it depends on when you were born. So it was always 65. It was 65, but those are for people born 1937 or earlier. It was 65. And then in the early 80s, um, Congress actually did something about Social Security reform and increased the full retirement age. And it started for those born in 1938, and they kept adding 2 months to it. 2 months, 2 months, 2 months. And so for those who are born in 1960 or later, we're at 67. No changes yet. So this is the latest we've had. I think this was back from 1983. So the FRA is now 67 if you're born in 1960 or later. Is that going to change in the future? Don't know. Congress will need to do something to bolster the Social Security system. All right. So what if I claim early? What does that mean? Well, you can start at early as 72, but you're going to have permanent reductions. Permanent reductions. So what that means is when there's cost of living adjustments, it'll be based on a smaller amount. You're not going to get as large of a benefit. The benefit could be reduced by 25 to 30%, depending on when you take Social Security. And the reduction is actuarial based on the number of months before FRA, before beginning receiving payments. And the reduction is permanent and will continue for the rest of your life. So it's an irrevocable decision. It's going to have impact on your family benefits too. It'll reduce the spousal benefits, survivor benefits, and any children's benefits. However, you can change your mind. You can change your mind. So let's say you took it early, but you're still working, or you went back to work and you have 12 months, 12 months to pay it back. And then it kind of resets the calculations all over again. So in the past, the law changed many years ago, but previously you had up to 10 years to change your mind, but not anymore. You have 12 months. If you change your mind, you just got to pay it back for the amounts that you received, the gross amounts you received, without any interest, interest free. So that could be a consideration to think about is if you need to take a mulligan. Oops, I didn't mean to do it. As long as it's within the 12 months, you can turn it off, pay back to Social Security, and they'll reset the retirement calculation. So if you claim before your full retirement age, and if you keep working, benefits could be withheld if your earnings exceed certain limits, and we'll go over those limits there. So applies to benefits received before reaching FRA. And the benefits for any dependents drawing in your account will also be withheld. So you have to pay it back if you make more than a certain amount. The first payment typing, the first month you can receive a benefit payment is for the first month in which you are 62 for the entire month. So it basically means the month after you turn 62. Well, I turned 62 in January, so I can't start in January. It's going to be after the full month that I'm 62. So that's going to be in February is the absolute earliest, or maybe closer to March, right? So it's not going to be on your birthday. It's going to be after your birthday, the first month after you turn 62. So when's it not a good idea to claim early? Well, if you're still working, not a good idea to claim early because you'll be subject to the earnings test. Or you have a younger spouse who's going to depend on survivor benefits. If you take it early, it's going to be reduced. Or if you have dependent children who will receive benefits on your account. But I know sometimes we have health issues, longevity issues. I've had cases where I have clients who were chronically ill, or they were terminal, or they were cancer survivors. For those people, there's some uncertainty about their longevity. Or if you seriously have concerns about longevity, yeah, claiming early is going to make some sense because if you die before ever claiming Social Security, you're not going to get anything. Your beneficiaries will not get anything. So if you do have health issues that are forcing early retirement, instead of claiming retirement benefits for Social Security, how about consider applying for disability benefits instead? The benefit, the disability benefits equal a full unreduced retirement benefit. And if you're on disability insurance, when you reach full retirement age, the disability benefits will automatically convert to retirement benefits. But it's a pretty high bar to pass. The disability must be expected to last at least 1 year or result in death. So you're going to need some medical letters and opinions about that. It's a process. It's a process. It's not really easy here, but if that's a consideration, something worth pursuing. So let's talk about this earnings test. So for 2026, this is the 2026 amount here, is the annual exempt amount before full retirement age is 24,480. So if you make less than 24,480, then you're not going to have to pay back your Social Security. But if you do, you will. Uh, and then there's the higher limit, and that's when you're in FRA, the year of FRA, and that's up to 65,160. So the benefits withheld when the earnings exceed these exempt amount. So you withhold $1 for every $2 of earnings in excess of the lower exempt amount, or $1 in benefits for every $3 of earnings in excess of the higher exempt amount. So when you take a look at longevity expectations, your mortality, your health situations, and all that, we don't know. We don't know. We can't predict it, but there's the life expectancy calculator on the Social Security website, which is not perfect. There are other websites out there that help you calculate your life expectancy. The ones, where you answer some questions, again, it might not be exact because your medical records aren't being reviewed. Um, the other considerations are if you have a spouse or an ex-spouse. So I plugged in my birthday, and according to the Social Security um, calculator, if I live to 70, I'm expected to live to age 86. If I live to 67, I'm expected to live to age 85. So, that's based on statistics, based on senses and all that information here. So it doesn't take into account your health situation, your lifestyle, and your family history. There are other private websites to do that. Be very careful with those websites, though. If the website's asking for your social security number, your date of birth, your mother's maiden name, um, it's probably a scam website, so stay away from those. So make sure it's a legitimate website. There are experts out there who do these calculations, and of course, on their form it says you can't hold us to this because if you die before this, your family can't sue us or whatever, right? So there are calculators there, but I've had client situations where, for one client, he had a heart situation. I told him, go ask your cardiologist, am I going to beat age 80 or not? You know, and of course, you can't hold the doctor to it because we never know. So if you take it before your full retirement age, you got to pay back $1 for every $2 over 24,480. Uh, in the year you reach the full retirement age, if you make more than $65,000, you got to pay back $1 for every $3 over that amount. But if you are still working after your full retirement age, you can make as much as you want. You don't need to pay it back. So I've had clients where, They took Social Security early, but they stopped working. And then they went back to work at their full retirement age. So it's your call on how you want to do that. So instead of trying to figure out this complicated calculation, there's a calculator on the Social Security website. You can click on this, plug in what your earned income is going to be, and you can find out how much you got to pay back. So there is a earnings test calculator on the website. Okay, so what happens if I claim early? Well, FRA, if you're born 1960 or later, is age 67. You're going to get 100% of your PIA. You get 100%. Pretty easy there. Also, you work as much as you want. No payback of Social Security. They're not going to take money out of your Social Security to pay them back. Now, if I take it a year early, age 66, that's 93% of the benefit. 2 years, age 65, 87%. 3 years, 80%. 4 years, 75%. If I take it at age 62, which is the earliest year I can take it, it's a 30% haircut. You get 70% of the benefit, and that could result in a lot of money. So that's something to seriously consider here. So it's not an easy decision. It's not a one size fits all decision. It depends on your personal situation. So here's a math example of that. If I claim Social Security at 67, the monthly amount's $2,002. I took that number from the average Social Security benefit of Americans, $2,002. So if your benefit is going to be more than that, you're above average. If you're going to be below that, you're below average. And I've had clients who did their best to avoid paying Social Security tax, and as a result, they get an itty bitty benefit. Or if you're a minister and you opt out of Social Security, you get none. For the younger ministers I'm meeting, pastors, ministers, clergy, I say you should participate in Social Security because I have yet to see someone who opted out and actually invested the money that they would normally pay in taxes. And it just kind of disappears in their cash flow. So it's a pretty good return on your investment. Add up how much you paid in Social Security, the amount you're going to get back is generally more than that. And that was really true for the first person who got Social Security benefits. She got way more than what she ever paid in. And I forgot what her name was, but it was like 100 times on what she paid in. So it's a pretty good deal. All right. So if I took it at 67, it's $2,002 a month. If I took it at 62, it's $1,400 a month. That's a $600 a month difference. That's $600. To me, that's a pretty significant cash flow. That buys a few lunches, doesn't it? Or that can be $7,200 a year. So if we plug in a life expectancy of 86 years, let's just say 86. So if I took out 67, the lifetime amount would be $456,000, which is 86 minus 67 times 2002 times 12. Age 62, I started 5 years earlier. So some people think, well, I'm getting it 5 years earlier. Yes, you are, but you're getting a lower amount. So your lifetime, if you live to 86, is $403,000. So the difference is around $53,000. Now, this is going to be a bigger difference if you live past age 86. If you live to 95 or 100, it's going to be a significantly bigger number. You can do the math yourself to see that. Now, what if I claim later? Well, every year you delay after your full retirement age, instead of a discount, you get a premium. It's 8% a year. So if I wait till 68, that's 108%. 69, that's 116%. 70 is 124%. It was actually a better deal when your FRA is at age 67 because you had another 8% increase. That was like, what, 132%. But that was back when the FRA was for 66. So now it's 67. So what happens if I claim later? Same numbers here. So at age 70, instead of $2,002 a month, it's $2,482 a month. That's almost $500 a month difference here. So it's $1,000 a month difference from 62. $1,000 a month. That's a pretty significant difference. So if I plug in age 86 here, if I compare, The lifetime amount at age 70 will be 476,000. Now, again, if I live way past 86, the lifetime amount would be significantly higher. And the differences would be higher. $73,000 difference versus age 62 or $20,000 versus 67. And, you know, and these amounts are actually lower than what they should be because what did I not factor in? I didn't factor the cost of living adjustment. I just did the simple math here. So the difference is actually higher than the numbers you see on this screen here. It's actually higher because of the cost of living adjustment. And if you remember in 2023, we had a pretty significant cost of living adjustment because in 2022, we had high inflation. High inflation. And I know there's what's that, a couple of years where the cost of living adjustment was zero because we had negative inflation or zero inflation. All right, so what are the benefits of claiming later or continue to work? What are the benefits you keep working? Well, you get an opportunity to add more to your retirement accounts, add to your 401k, add to your IRAs. Helps bolster one of the legs of your retirement stool, right? So my tip there is when a client comes to me and says, Larry, I want to retire. I said, that is great. Let's put you on a retirement diet. Let's max out your retirement plan contributions so you know what it's like to live on the lower cash flow. Also, by continuing to work, you're going to increase your Social Security benefit because you might be kicking out some years where the earnings was zero. I mean, going from zero to a yearly wage is a big deal. It's a big deal. And of course, you have more cash flow to save, bolster your savings, or if you still have debt like a mortgage or credit cards or car loans or whatever, if you keep working, you can pay down your debt, which will make your retirement a lot simpler, a lot simpler. Otherwise, it'll be a bit of a struggle. And also, make sure you understand what your monthly expenses are going to look like. You have an idea what they are already, so you can take a look at that and see how far off you are because you can't rely on Social Security solely to cover your retirement expenses. So, speaking of continuing to work, here's your 2026 retirement plan updates. So for 2026, you could put $7,500 into an IRA. Doesn't matter if it's a Roth or traditional. If you're 50 or older, you can add an extra $1,100 as the catch-up provision. So that's $8,600 into an IRA. If you're married, both of you can do that. Or if you're still working, you have employer-sponsored retirement plans, you can add to your 401k or 403b, TSPs, 457s. So the maximum for 26 is 24,500. But then if you're over 50, your catch-up is going to be $8,000. That's $32,000 there. Now, we now have what's called the super catch-up, and that's for age 60, 61, 62, and 63. That's an additional 11,250 instead of the $8,000. So that's what nearly what $36,000 you can put into your retirement account. If you're married, both of you do it. That's $72,000. That really helps bolster your retirement. We gotta bolster your retirement. So, number one, put yourself on a retirement diet, less cash flow, maximize your retirement plans, bolster that, and keep working. You'll bump up your retirement benefit. Now, spousal benefits payable to an individual currently married to a living worker who's drawing Social Security on the worker's account. Now, we have situations where the spouse might not have worked, stayed at home, or has low earnings. So, if the spouse who hasn't worked or low earnings can be entitled up to half or 50% of the retired worker's full benefit while the retired worker is living. If you're eligible for your own retirement and spousal benefits, Social Security is going to base your benefits first. Now, if the spousal benefit's higher, you'll take a combination which is equal to half of the higher earner's benefit. So to qualify or to be eligible for the spousal benefit, the individual receiving the benefit must be at least 62. So that's the earliest. But again, if you do it early, you take a haircut, you take a discount. The worker spouse must be qualified for a benefit. The worker spouse must have signed up for their own benefits. So there's some coordination to be done there. And the spousal benefit must be greater than the applicant's workers' benefit. Okay, so let's talk about this issue of, oh, I got to take it now because Social Security is not going to be there if I wait. Well, that's a myth. That's a myth. So every year we get the Social Security, Medicare, and Trustee report. Um, it came out a little late this year. We got it in June of 25. The year before we got it in April. Some years we get it in March. So we'll see when we're going to get this in 26. I always look forward to see what it says. Yes, it's going to tell us the condition of the Social Security Trust Fund. So based on the last report, we've got enough money in the Social Security Trust Fund to pay 100% of the benefits through at least 2033. 2033. Now, after that, it's going to drop to 77%. Now, that year kind of moves around depending on what's going on with our economy, how many people are working, all those kind of factors involved there. And then that 77% kind of wiggles around 75%, 70%, 85%, or something like that. Again, it depends on the Social Security Trust Fund. So I'm always looking forward to this report every year. But the good news is it looks like our disability insurance trust fund is okay, at least through 2099. The health insurance trust fund, that's Medicare Part A, looks like we're good there until 2034. Ooh, and that drops to 89%. So Congress has got some work to do to bolster the system here, and we don't seem to have a lot of bravery in Congress. So you need to pressure your legislators about this. I would put this top of mind. I know it's like a third rail politics and they're too scared to touch it. But if they made reforms earlier, like 20 years ago, because the last time they did this was 1983, it would have been smaller adjustments. So the longer they wait, the bigger the adjustments are. It's going to be more painful. So anyway, there's some concerns about that. So for 2026, the base premium for Medicare for Part B is $202 a month. So that's about an $18 per month increase. That's double. It's about an 11% increase. So it's double what the increase was from 24 to 25. The base premium for Part D is $38.99 for 26. And and the COLA for 26, the increase from the 25 Social Security benefit to 26 is 2.8%. Well, guess what? The COLA is less than the Medicare increase. So this is where people get a little upset when they find out, oh, my check is shrinking. Well, it's because of the increase is less. The increase in Social Security is less than the increase to the cost of Medicare premiums. So it's about, yeah, on average, if you're receiving an average amount, which is a couple of thousand a month, that's like a $56 a month increase. But then, but then you have a decrease in your Medicare too. And your Medicare premiums are also based upon your income. And so who are the trustees? Well, Secretary of Treasury Scott Bessent, the Secretary of Labor Lori Chavez DeRemer, the Secretary of Health and Human Services Robert F. Kennedy Jr., and the Commissioner of Social Security is Frank Bisagno. That's who they are right now. All right, let's talk about this enhanced deduction for seniors. First of all, it's got nothing to do with Social Security, despite what you hear in the news, despite what you hear from the politicians. The enhanced deduction for seniors has nothing to do with Social Security, especially when you hear, especially on social media or from politicians, they say, no tax on Social Security. No, this has nothing to do with that. This is a $6,000 deduction if you're over age 65 or older. 65 or older. Born before January 2nd of 1961. And this is on top of the additional standard deduction if you're 65. It's 1,600 if you're married filing jointly. $2,000 if you're unmarried. So for married filing jointly, that's 1,600 times 2, that's $3,200. This is above and beyond that. However, there's an income phase out. Starts at 75,000 for unmarried, 150,000 for married. You get a $6,000 enhanced senior deduction. It's got nothing to do with Social Security. So the AGI consideration is that starts at 75,000 for singles, 150,000 for married filing jointly. If your income's below that, you get the full 6,000. If your income's between 75 and 175 or 150 to 250, you get a portion of the $6,000. If you're above 175,000 or 250 if you're married, boom, you get none. So it depends on where you fit in on the income here. It's just an enhanced senior deduction. It's got nothing to do with Social Security, but it's important for your tax and financial planning. Need to make some considerations with your required minimum distributions. You got to take your first distribution no later than April 1st in the year after you turn 73. And then you got to take a second one by December 31st. So one way to reduce your adjusted gross income, if you're forced to take a required minimum distribution, is to give it to charity, the qualified charitable distribution, the QCD. The maximum for 26 is 111,000. But you can do a once in a lifetime rollover to a charitable gift annuity. And for 26, the maximum is 55,000. Here's a here's a strategy I recommend for a lot of people, if it makes sense, is in the year you turn 74. So don't take a required minimum distribution at age 73. In the year you turn 74, before April 1st, roll over 55,000 from your IRA into a charitable gift annuity. You pick your charity. It's going to pay, I don't know, something like 7.25% for the rest of your life. And then whatever's left in annuity upon your death is going to go to the charity. All the major charities offers charitable gift annuities. All your universities do. So pick your favorite charity and you talk to their experts about that. So you'll get income for the rest of your life. You can start that when you're 75, push into years 75. So you don't bump up your income to cut yourself out of the senior deduction. And then we talked about the Social Security claiming planning. Take it early, take it FRA, take it later. It's going to depend on where you fit into the adjusted gross income situation when it comes to claiming the senior deduction. So it flows to line 13B of the 1040. So it's below the lines after adjusted gross income, which is line 11B, but it's above your taxable income. So it's a direct reduction of your taxable income. It doesn't matter if you take the standard deduction or itemize. Okay, let's close out with the Social Security Fairness Act. It does away with the windfall elimination provision, the WEP, or the Government Pension Office, the GPO, starting in 24. So it's a retroactive law. It was signed in by President Biden in January of 25, but it applies back to 2024. Now, these are for people who didn't get their Social Security benefits because they had employment that has a pension and they weren't participating in Social Security for those jobs. But maybe they had another job. A lot of firefighters I know had side gigs, or a lot of police officers I know have side gigs. So they paid into the Social Security system. But because they have their government pensions, they weren't allowed to get Social Security. But that changed with the Social Security Fairness Act, retroactive to 2024. The government pension offset for surviving spouses. And I have a personal example. It's my dad. My mom died in 23. My dad worked for the state of California, so he gets a pension from the state of California. But my mom had a regular job, so she was getting Social Security. Well, in 23, when we applied for the survivor benefit, Social Security said, nope, you're not going to get it because of the government pension offset. Well, that's gone. So he's going to get his 2024 retroactive payments plus 25, and then now he gets a monthly amount. So, this is something to keep an eye out for. So there's, I don't know how many million people that this qualify for. Quite a few people where they were denied Social Security. Now they're getting it. So teachers, firefighters, police officers, state and local public employees. You work for the county, you work for the city, or you work for the state. Federal employees covered by the Civil Service Retirement System. I think that changed in 1986 or so, something like that. So after the mid 80s or so, if you're a federal employee, you are covered by Social Security. So there's been a change in the federal retirement system. Or if your work was covered by foreign Social Security, if you had foreign Social Security, you didn't get your Social Security, even though you paid into the system. So that all changed with the Social Security Fairness Act. So keep an eye on that. So if you qualify, go to the Social Security Administration to apply for it. They're not going to do it automatically for you. You have to go apply for it. So that means line 6A is where you report your Social Security benefits. That's the gross amount. 6B is the taxable amount. For most of our clients, that's going to be 85%. So like this Social Security Fairness Act, you're going to have a retroactive payment for 2024. So 60 is if you elect to use the lump sum election method, and if that results in a lower tax, take advantage of it. Take advantage of it. So it's line 6C. It's the box itself is new, but the calculation has been around for a long time, and and it helps you calculate if the taxes are lower using the previous year's or that year's income and amounts. You do not amend your previous year tax returns. You do the lump sum method. The uh, the worksheet for this is on page 11 of publication 915, Taxation of Social Security Benefits. So, in conclusion, collection strategies here. We gotta factor in your longevity, your mortality. When you're gonna die. We don't know that, right? Or maybe you do. Identify all your eligible benefits. How many legs of your retirement stool do you have? Evaluate options using lifetime cash flow. What are my expenses? Where are they going to be? Um, am I going to stop making a mortgage payment because I only have a couple more payments to go? That could be consideration. Car loans, credit cards, those kind of things. But I would make an informed decision. Don't rely on unsolicited advice. We get that a lot, right? Or unqualified people giving you advice, or what friends are doing, what in-laws are doing. That's not necessarily the best thing to do. Everyone's situation is different. So I would I would cover my ears of the noise that you're going to hear and get review this in context. Also, who are you asking for advice? Are you asking for advice from someone who is not going to make any money, depending which decision you make? I'm not going to sell you an annuity. I'm not going to sell you an investment or financial products. I just give advice. And also, I look out for my client's best interest. So watch out, see the context, see what kind of conflicts of interest might exist from someone who's giving you advice. So be very careful about that. Now, what did we not cover here? There's a lot more to Social Security. We didn't cover, there's a deeper dive in spousal benefits, or even if you have ex-spouses or ex-spouse, the deemed filing rule. There's a lot of considerations here when it comes to claiming for married couples. It's a bit tricky. Some of the tricks we had have been eliminated, but there's still some that still exist. Survivor benefits, dependent benefits, collection strategies, and we didn't talk about Medicare, of course. That's a whole big subject in itself. So my last slide here, we got some resources. The Social Security Administration, SSA.gov, but I gave you links to their earnings test, the retirement age calculator, the Social Security detailed calculator, early or late retirement, and life expectancy calculator. So I hope these resources are helpful for you. I hope you can make a good decision here. Remember, if you do make a decision and you change your mind, you got 12 months to return the money and start all over again. But if it's past 12 months, you're pretty stuck with your decision. So thank you for your time today. I hope this was helpful. If you have any questions, go ahead and contact me. Need help with making this decision or running some numbers, I'm available to help. I love doing this. If there's other topics you'd like to hear, let me know. And thank you for your time today.